Hello, this week we got some surprising data from Statistics Canada that really paints a picture of an economy under quite a bit of pressure. The numbers show that Canada is walking a very fine line right now, somewhere between stability and an actual contraction. So let's dive in and take a look at what this data really means. So the big headline number came from the August report on our gross domestic product, or GDP. Statistics Canada reported that our economy actually shrank by 0.3%. Now, this was a bit of a shock because most analysts were expecting things to be flat, no growth, but no contraction either. A negative number like this, well, it immediately gets people talking and raises some serious concerns. And of course, a contraction like that leads everyone to the same big question: are we heading for a recession? It's an absolutely valid concern, especially when you consider that this is the fourth time in the last 5 months that we've seen the economy shrink. So to really assess that risk, we need to be crystal clear on what a recession actually is. So first up, let's tackle that recession question. We'll start by defining the term, and then we'll look at the data we have so far. The most crucial point here is the official definition. A technical recession isn't just one bad month. It's generally defined as 2 straight quarters, that's 6 months back-to-back, of negative GDP growth. It has to be a sustained period where the economy is contracting. And this timeline really shows that tightrope we're walking. You can see the economy contracted at an annualized rate of 1.6% in the second quarter. So that's one negative quarter down. But here's where it gets interesting. Even though August was negative, Statistics Canada's early look at September suggests a small rebound. That puts the entire third quarter on track to be slightly positive, at about 0.4%. So for now, we've narrowly avoided that technical recession. Okay, so if we aren't officially in a recession, why does it feel like things are slowing down? Let's get behind these numbers and see what's really going on. A really significant part of this story is pressure from outside our borders. Reports from all sorts of industry groups show that the ongoing U.S. tariffs on key Canadian exports, things like steel, lumber, and aluminum, are having a very real impact. All this trade uncertainty means fewer exports, and it's making businesses hesitant to invest and expand. And when you look inside the economy, you can see a clear split. It's almost a tale of two economies. The sectors that make goods are the ones feeling the most pressure. In August, manufacturing, which is very sensitive to trade, shrank by 0.5%. Mining and energy fell even further. But on the other hand, the sectors that deal directly with you and me, like retail and real estate, actually showed some growth. That tells us Canadian households are still spending, which has been a key source of resilience. I think this quote from financial analyst Robert McLister really captures the moment perfectly. He said, "Canada's economy is clearly tiptoeing on the edge of recession. We're not in a full downturn, but the balance is incredibly delicate. It honestly wouldn't take much to tip us one way or the other." Okay, so that's the big economic picture. But what does it all mean for your wallet? Let's talk about the two things that matter most: jobs and the cost of borrowing money. The Canadian job market has been on a real roller coaster lately. This data from RBC Economics shows just how much the monthly numbers have been swinging. We had a huge surge of 83,000 jobs back in June, which was followed by 2 straight months of losses and then another big gain in September. This kind of turbulence really just reflects that broader economic uncertainty we've been talking about. But if you look past all that monthly noise, the bigger picture shows a bit more stability. As of October, the overall unemployment rate has held pretty steady at 7.1%. We aren't seeing that sharp spike in unemployment that you'd typically expect in a major downturn. So you could say the labor market is definitely bending, but it hasn't broken. However, there's some important context here. While that rate is stable month to month, it is 0.5 percentage point higher than it was this time last year. And according to RBC, a lot of that increase is because new people entering the job market, particularly young Canadians, are finding it harder to get work. All right, all of this leads to the million-dollar question for anyone with a mortgage or a loan. What is the Bank of Canada going to do about interest rates? Right now, the Bank of Canada has been very clear that it's in a watch-and-wait mode. Essentially, they're sitting on the sidelines. While the data is weak, it's just not weak enough to force them to change policy. As one analyst cleverly put it, the bank has basically said the economy would need to faceplant harder before they would even consider cutting their key interest rate. And the financial markets are reflecting this stance. As of today, the odds that the bank will cut rates at their next meeting on December 10th are just 9%. That's really low. So for anyone with a variable rate mortgage hoping for some relief soon, this is a pretty clear signal that it's likely not coming just yet. So we end up right where we began, on a tightrope. The data shows an economy that's clearly under strain from trade pressures, but it's also being held up by resilient Canadian consumers and a job market that's still stable. The crucial question this leaves us with as we head into 2026 is which of those forces will win out? Is resilience or recession the more likely path for Canada?